Let's get right into it. Today, we're talking about the FOMO effect. We're going to break down how this one powerful and, let's be honest, really costly emotion can fuel some of the biggest market manias we've ever seen.
I mean, you know that feeling, right? That knot in your stomach when you're watching something just go to the moon and you think, man, everyone is getting rich but me. Well, that's not just a passing feeling. It's a super powerful psychological trigger. And believe it or not, it shaped a ton of financial history.
So what is FOMO really when we talk about money? Think of it like this. It's a kind of anxiety that just completely hijacks the logical part of your brain. All your careful research, it goes right out the window. All that's left is this urgent, almost primal need to jump in right now before you miss out. And, as we're about to see, that feeling is pretty much the rocket fuel for market manias.
But here's the wild part. This isn't some new thing from the internet age. Nope, it's literally wired into our DNA. See, for our ancient ancestors, being kicked out of the tribe was a death sentence. You'd lose food, safety, the whole deal. So fearing exclusion kept us alive. Fast forward to today, and that exact same survival circuit in our brain lights up when we see other people making a ton of money. It screams at us, join the herd, quick, even if that herd is running straight off a cliff.
All right, so how does that ancient instinct get turned against us in today's markets? Let's get into the nitty-gritty of the psychology here and see how our own brains take this fear and just amplify it into full-blown market hype. Okay, so FOMO is kind of like the ringleader of a gang of bad habits in our brain. It almost never works alone. First up, you've got loss aversion. Now, studies show that the pain of missing out on a gain feels just as bad as actually losing money. It's crazy, right? That feeling makes us chase after things that are already soaring. Then you've got the classic herd mentality. When we're not sure what to do? We look at what everyone else is doing. Their buying becomes our social proof that it's a good idea, even when it's super risky. And finally, the availability heuristic. All those flashy, I got rich overnight stories you see on social media, your brain treats them like they're way more common than they actually are. You put those three together and boom, it's a perfect storm for making some really bad emotional decisions. And that brings us to the thing that has poured gasoline on this ancient fire, the modern catalyst. I'm talking about the digital hype machine. And just look at these numbers. I mean, they're kind of mind-blowing. 80% of Gen Z investors get their financial info from social media. Let that sink in. Over half of all Americans have made a money move just because they saw some curated lifestyle online. And get this, more than a third of retail investors are straight up admitting they made a decision because a Finfluencer told them to. This isn't just a small change, it's a total earthquake in how people think about markets. So how does this actually work? What's the engine behind it? Well, social media platforms are built for one thing, to keep you scrolling. They create these, well, they're called algorithmic echo chambers. Basically, what happens is a trend gets hot, the algorithm sees you like it, and it just feeds you more and more of the same. This creates what they call an information cascade. You see so many people jumping on board that you start to think, well, they can't all be wrong, and you end up ignoring your own common sense just to follow the crowd. Your own judgment just gets totally washed away by the digital tide. Okay, so this all sounds bad, but what's the real cost? Can we actually put a number on it? You bet. Researchers who track this stuff found something that is just, wow. During those moments of peak FOMO, when everyone is the most excited and piling in, the market's average returns actually go down by 1.7%. Just think about that for a second. The exact moment everyone is screaming buy is, on average, one of the worst times to do it. And hold on, because it actually gets worse. There's this measure called the Sharpe ratio. All it really does is ask a simple question. Are you getting paid enough for the amount of risk you're taking? Well, during these FOMO peaks, that number drops by a whopping 4%. And this is so important. It means people aren't just getting lower returns, they're taking on way more risk for those worse returns. It's a total double whammy. This quote from the research just hits the nail on the head. It says, the party is already over by the time FOMO becomes the dominant market force. And what does that really mean? It means when you and everyone you know are feeling that intense urge to buy, the smart money, the pros, they're already quietly heading for the exits. The emotional crowd is basically just holding the door open for them. Okay, let's zoom out a bit, because even though we're talking about social media and algorithms, this is not a new story. Not by a long shot. The technology changes, but the human behavior, it's a timeless, repeating pattern. Same story, just a different asset. I mean, seriously, we have seen this movie so many times.
We're talking about tulip mania back in the 1600s, where people were trading their houses for a single flower bulb, all the way up to the meme stock craziness of just a few years ago. The details change. It could be tulips or shipping companies or dot-com stocks, but the script is always the same. There's an exciting new thing, everyone gets swept up in the story, FOMO takes over, prices completely disconnect from reality, and then, well, you know how it ends.
And hey, if you're sitting there thinking, well, that's other people, I'm too smart for that, let me introduce you to Sir Isaac Newton. Yeah, the Isaac Newton, the guy who discovered gravity, one of the smartest people who ever lived. He lost a fortune, we're talking millions in today's money, in the South Sea bubble. And here's the kicker, he actually sold early and made a profit. But then he saw his friends getting even richer, the FOMO kicked in, and he jumped back in right at the very top. If it can happen to him, it can happen to anyone.
Which of course brings us to the huge debate happening right now, AI. Is this a legitimate sustainable boom, or are we watching another classic bubble inflate in real time? I mean, the arguments for it being real are pretty solid, right? The big companies have tons of cash, the valuations aren't quite as insane as the dot-com bubble, and a lot of smart people think AI is the next industrial revolution. But the arguments for a bubble are also pretty convincing. Valuations are way ahead of what these companies are actually earning. Some of the investing looks a little circular, and let's be honest, some of the tech feels a bit like autocomplete on steroids. The jury is definitely still out, but you can feel the same emotional currents pulling on this market.
Okay, so this is the big question, right? How do you actually defend yourself against this, against an emotion that's hardwired into your brain? Let's talk about some real actionable strategies. The whole game is to build a system for yourself that takes emotion out of the picture. So, number one, create rules. Before you even think about putting $1 in, you need to have crystal clear, black and white rules for when you'll buy and when you'll sell. No exceptions. Number two, automate. Just set up a set it and forget it monthly contribution. It's the simplest way to stop yourself from trying to time the market based on a gut feeling. Third, and I love this one, do a pre-mortem. Pretend the investment has already failed miserably. Now work backward and figure out all the reasons why it went wrong. This forces you to see the risks that your excitement is trying to hide. And finally, a big one for today, a cooling off period. You see a hot tip on social media? You force yourself, you mandate a 24-hour wait before you do anything. Give your rational brain a chance to catch up. You know, in this kind of environment, the job of a financial advisor has totally changed too. The best ones today aren't just stock pickers. They're more like behavioral coaches. Their real job is to be your financial North Star, to be that calm outside voice that stops you from running with the herd. They're there to tap you on the shoulder and say, hey, it looks like your emotions might be driving the bus right now. When you boil it all down, it really comes to this. The market has always been a kind of theater for human emotions. But today, that theater is global, it's digital, and the show runs 24/7. The biggest challenge for anyone investing today isn't about picking the next winner. It's about figuring out how to be the rational actor in a theater that's getting more and more emotional by the day. So I'll leave you with this one final thought to chew on. In a world that is just screaming at you with digital hype, a world that's constantly promising you'll get rich tomorrow, could it be that the smartest move you can make is actually the most boring one? Makes you think, doesn't it?